Welcome to American Dreams, Keys to Success, with your host, Alan Olsen.
Welcome back. We're here today with Dick Boyce. Dick is one of the managing directors of Texas Pacific Group, a private equity firm located here in San Francisco Bay Area. Welcome to today's show, Dick.
Great to be here, Alan.
So, Dick, we loved having you here on American Dreams, and one of the areas that we like to first start out with getting familiar with your background.
Sure.
How did you move up your career ladder to get where you are today?
Well, I grew up in Pennsylvania, got an engineering degree back east, was a chemical salesman for a while, actually in plastics, if you think back to the great movie The Graduate. Then business school out here at Stanford, and I decided to establish roots here in California. I worked for Bain Consulting for about a decade out here, both in Boston and then out here in California. And then went to Pepsi to get a quote-unquote real job and an operations job in the bottling company. CFO of Pepsi-Cola, and then ran the bottling operations group. And then ultimately went to Texas Pacific Group in their first fund and founded their operating group about 15 years ago.
And then for where you start with Texas Pacific Group and total capital, where are they today?
About $50 billion in total capital. When I joined in 1997, we had a little less than $1 billion.
So you've really seen some growth there.
We've had a very good run. We're one of probably the largest 5 to 6 firms in the industry today, yes.
So if you, on a day-to-day basis as managing director of operations, what does that entail?
Well, several things, Alan. On the front end of our business, on due diligence, as a private equity firm, we're always trying to evaluate the companies that we buy. And we're different than venture capitalists. We really need to understand the company in quite a bit of detail because we're making large investments, usually for control, not seed investments early on in the company. So our operating group actually does a lot of the due diligence to really understand how the company operates today, what the caliber of management is, and whether we can improve the company or not. Then once we've invested in the company, we often play a support role with management to accelerate or to turbocharge some of the operating plans in support of the deal guys. The deal guys tend to run the diligence on the accounting and on the legal side, on industry sector knowledge. So we partner with the deal guys pretty closely, hand in glove, from really cradle to the exit of the investment.
Are you sitting on board seats?
Typically we will. I've sat on quite a few over the years, but it varies. Sometimes we can be more effective in the company by being a guy helping the CEO succeed, not being on his board at the same time. It creates some conflict in some cases if you try to do that.
What are some of the projects or companies that you work with today?
Well, today, right now, is a company called LPL Financial. It's one of the leading independent back office and brokerage management firms in America. A very successful company, public, based both in Boston and in San Diego and Charlotte. And I play the role that we often play in the board, really, at this point, which is with an established, successful management team and a great trajectory. We play much more of a governance role and a strategy role, and some support in some operational issues. Whereas, if I go back to Burger King a few years ago, completely different situation. We decided to invest in Burger King on a transformational basis to significantly change out the management team, change the capital structure, frankly, change the advertising, almost anything you could name. We did. In that case, a group of us really lived down at the company until the company had the right management team and was a stable operating business. And it turned out very, very well for us once we got through all those changes.
When you're looking at companies today with the flow of technology and working all the automation, do you find it's challenging to turn companies on a dime?
Well, it's certainly, the bigger the companies that you buy, they're like a battleship, as people say. It's hard to turn them quickly. I will say you're alluding to something else, though, that is important, which is technology creates discontinuities in business. So, for example, we bought out of Primedia, ApartmentGuide.com, then merged it with the eBay business called Rent.com. It turns out that former business historically has been almost entirely analog. We shifted all the rental business almost entirely within a year over the digital side, eliminated all the print media and costs with no impact on our consumer who actually wanted the information in a digital online fashion. So there's some real interesting investment opportunities where you begin to shift the business model using the technology, actually.
Has there been, in the current economic woes, I guess, looking at the economy, about the amount of debt that riddles this nation, what steps have you taken within the companies that you manage to oversee whether or not the debt is too much, and how do you get that in line with where it needs to be?
It's a very challenging balance, Alan, to compete in today's market in terms of buying companies and to compete against the alternative they have of going public. You have to put some leverage on your company to pay the price consistent with getting the transaction done. So the balance always is how much can I afford to pay in total and make this deal work? And then what's the mix of debt and equity? And then the third piece you have to weave in is how much cash do I have to pay down the interest, obviously. So that's a pretty delicate balance. Obviously, we're looking at a U.S. nation that is way over-levered compared to history. And we're seeing individual states and individual communities, certainly within the state of California, actually find bankruptcy. I think in our industry, the ability to put leverage on the company varies very much with the capital markets. So sometimes the market is really the master, not ourselves. We only can put as much leverage on as the financiers will allow us to do on terms that we're allowed to do. So sometimes you can see where too much leverage gets put on because the financing terms are so attractive. You decide to take them as your competitors would when they bid against you. I hope I'm not making it too complicated, but as a result, I think usually the market is the measure, and if you get in trouble, you're not going to be able to borrow again on the same terms.
I'm visiting here today with Dick Boyce. He is one of the managing directors of Texas Pacific Group, and I'd like to come back and visit more on this debt and the current state of the economy. We'll be right back after these messages.
Protecting your family's health and welfare is a sacred trust. At Greenstein Rogoff Olsen Company, we know that sound financial planning will protect them now and in the future. We're certified public accountants with tax services for the highly successful. For your business and your family, call GrowCo.
Greenstein Rogoff Olsen Company will help you manage your financial affairs so you can focus on what's really important in life.
GrowCo, helping you along the way.
Apple pie, baseball, and now here's All-American Alan Olsen.
Welcome back. We've been visiting today with Dick Boyce. He's the managing director of Texas Pacific Group Capital, a private equity firm headquartered here in the San Francisco Bay Area. Dick, before the break, we were talking about leverage in today's economy, and I want to move this into the whole area of mergers and acquisitions and how that's affected the IPO markets.
It's a great question, Alan. And what I think I didn't appreciate before I got into this business is that there's really a cycle to this. That when the equity markets are attractive, i.e. the stock market is attractive, it becomes so easy to go public, if you will, at a high price. It's very hard for someone to merge or acquire in a competitive basis because the prices are just hard to support. And it cycles the other way. So when the IPO markets are really unattractive, that's when people that own corporations can use their stock and effectively both on either side of a transaction. It could be buying or selling, depending on what their position is, if they are acquirer or the acquiree. So in our business, the way we think about first entering, in other words, making an investment, is what's their alternative? Could they do an IPO, and how much could they gain in an IPO? And there's a lot of downside for an IPO. They become public for one, which many management teams, boards don't really want to be part of necessarily. They think it might limit their company. That's an advantage for us. But if the IPO markets are hot, as they have been, as you've seen over various cycles, particularly here in the Bay Area, we really can't compete with them. So if you look at over time, you'll see that IPO markets will ebb and flow pretty dramatically, and we go almost in the opposite direction. When it's hard for someone to go public, it's much easier for us to buy them or invest in those companies. They're probably more attractive at a better price for us. Now, on the flip side, I've been speaking as an investor. Now, on the exit side, obviously it also cycles. So we always try, most people in private equity try to do what's called a dual track process. When you're ready to exit investment, you want to have some strategic investors, people who know your business. You might want to have some financial investors like a private equity firm who simply see a good transaction. But you also want to have this private equity IPO option. So you keep them all competing against one another. But we've actually had as much success as any selling our businesses to other companies as acquirers who have strategic interest and have some operating interest and overlap, as opposed to doing a public offering. Also, it's a much cleaner exit for us to do a straight sale as opposed to an IPO, which then you have limitations and lockups and, frankly, all the public scrutiny as well.
Is there a challenge out there today finding liquidity in today's market with the bank industry and what's going on?
Again, the liquidity really cycles, but right now there's a tremendous amount of liquidity. But what happens when there's a lot of liquidity, there's high prices. So interest rates are very low. The Fed funds is virtually at zero. We can borrow money on term loans that are as low as they've ever been, but that's also driving the stock market to be the Dow at 13,500. So the prices are pretty high, so it's commensurate. So it's not like there's a free lunch. Every so often you catch the switch between a hot and a cold market and financing where you get a good investment risk return. But usually they sort of go in sync. So if there's great financing, the prices are probably pretty high.
The QE3 philosophy. It's been announced and it's coming. I guess what should we prepare for with this?
I think a lot of us are pretty uncomfortable with this. I'm pretty uncomfortable, generally speaking, with something that the New York Times editorial page advocates. So that might be part of my logic, which may not be the most fact-based. But we flooded the economy with excess liquidity now for several years. You know, one thing I really think about are seniors. So the stock price, the interest rates have been down for several years now, around zero in effect, and now are projected by Bernanke to do that. The Fed intends to keep them at that level to 2015. Well, senior who retired just 4 years ago, who thought they were going to earn a relatively risk-free return on their portfolio, their retirement portfolio, 4 to 5%, which is the long-term average over the last 50 years, is getting nada right now for 4 years. So think about those people anticipating several more years now of no interest growth, no interest rate growth in their portfolio, and a steadily declining retirement. That's tragic to me. And it's done because this economy is so poor, the only lever the Fed feels they can pull is put more money in the economy, when a lot of us would say there's many more things we can do with the pipeline project, with how labor is managed, with trade agreements, tax rates, Obamacare. There's a litany of things we could do differently to spur our economic growth versus just cheap money.
Seems like QE3 is really going out to hurt the lower and middle class people then.
I think it ultimately does hurt them, actually, in a way that people don't quite perceive, because people think there's some benefits to low interest rates, but the benefits are not going to be passed on to, in the way people may think, to middle income and low income. Those people need jobs, period.
Dick, we need to take a quick break. We're going to come back after the break. I'd like to talk about your time at Bain Consulting.
Sure.
We'll be right back after these messages.
Nothing's more important than spending time with your family. At Greenstone Rogoff Olsen Company, we're trusted advisors to the highly successful. Our goal is to help you find the right strategy to protect your wealth for yourself and those you love. Kids, why do I feel like I've just had an audit? As trusted advisors to the highly successful, we'll make sure that you don't lose your shirt.
Roco helping you along the way.
Apple pie, baseball, and now here's All-American Alan Olsen.
Welcome back. We're talking here today with Dick Boyce. He is one of the managing partners of Texas Pacific Group Capital, a private equity firm located here in the San Francisco Bay Area with companies throughout the world. Dick, before the break, we're talking about the leverage, the IPO markets, mergers and acquisitions, and ultimately we kind of concluded on these policies that in the QE3 and that have been put in place have really been hurting the middle class and lower class with higher energy prices, less interest rates. And so I want to move this discussion, though, into another segment, and that was your tenure at Bain Consulting. I understand you used to work with Mitt.
Yes, I did, actually, yeah. Yeah, Mitt hired me, actually, right out of biz school in 1979 at Stanford.
And so what was that like, working for him?
Well, he's an exceptional person. It's why a lot of people, myself included, who've known him over the years, not just actively endorse him, but actually work in his campaign. And many of us, myself included, never did this before at the federal level. He's really inspired us because we remembered what a great leader he was at Bain. He hired people in the Bay Area like Scott Cook, who founded Intuit, Meg Whitman, who basically built eBay, John Donahoe, who runs eBay today, Jesse Rogers, who founded Golden Gate Capital, Mayo Shattuck, who runs the largest utility in America called Exelon today. These are all people that were attracted by Mitt to TPG, to Bain, in those early years. And I think when I just think back of what really struck me is he was an amazing combination of very competitive, we've got to win, but he did it with a level of integrity that I've not commonly seen. People talk about Mitt as a 1%er, and they miss the real idea. I think the thing that people don't know as much about Mitt, he's not a 1%er on economics. I mean, he is, and financial performance of his businesses and himself personally, he's a 1%er on decent human being. And that doesn't come across in the media. I'm always struck by when I hear some descriptions of Mitt, I go, well, that's not the Mitt I know. It's sort of odd he's getting positioned as a tax cheat. I mean, If you said to people at Bain back in 1980, it's possible Mitt's cheating on his taxes, I said, are you kidding me? He won't even allow me to fudge the data a little bit in a presentation I gave to a client last week. We used to have an expression at Bain that said, that was, if you torture the data enough, it will confess. Mitt didn't go for that. That was not a joke to Mitt. No, we just present the data it is. We try to convince a client of doing one action or another, but you don't manipulate the data. It came in recruiting too. We used to, frankly, inflate our recruiting results. 80% of the people we've made offers to, we hired. It was always inflated in some fashion. When Mitt took over recruiting, he said, no, we have one of the best records in the country, but it's 40%. It's not 80. That's our baseline. Let's try to improve from there. So he always brought a level of integrity to everything we did. So it's just ludicrous when all of us say, there are probably some things you could get after Mitt on, but not decency and not honesty. And that's a big push of this campaign on us. So it's sort of tragic. The country has to move the debate onto the issues that really matter, which are jobs, particularly for middle class and lower middle class Americans.
So moving into this area, Mitt is a president.
Mm-hmm.
What are the initiatives that you see or that he's outlined that he'll be working on?
If I could comment on two things, Alan. First, I'd just like to comment on what he's going to be like as a leader that's different than we have today. The dimensions of a good leader have several elements, but one core one is they actually work on the right things. Mitt's not going to start by trying to improve healthcare access to a very small percentage of Americans, which is the thing that Obama spent his entire first year on. Mitt's going to repeal Obamacare at first dib because it's a $1 trillion addition to our deficit that we can't afford right now. He's going to push the XT pipeline, the Keystone Pipeline, which is absolutely critical to American jobs and to getting this lower cost energy. Number three, he's going to go after much improved trade. Obama was reluctant to go after trade, largely hamstrung by unions, believing that it was going to lessen jobs. We all know that actually you increase trade with Latin America as an example specifically. We're going to increase jobs in both countries, in both hemispheres, if you will. So there's a tremendous number of things that Mitt is going to do, but it starts by having the right idea of what we ought to work on. I mean, he's also going to clearly get after education. As many of us know, Obama talks about being a fan of charter schools, but will not advocate vouchers because the unions don't want vouchers. Mitt doesn't believe that your zip code should dictate the quality of your education. That's one of the moral issues of our generation, frankly, Alan, and it's being missed by the mainstream public. Along with this deficit, we can't leave $50,000 of debt per child, which is what we're doing today under Obama. We have to lessen that load so these kids have an opportunity. You had and I had growing up. It's not going to be the same if we continue to pile on this debt.
What's the solution in education?
Well, I think there's several things. Mitt is very market-focused first, market-based solutions. So he believes we have to have competition among schools, competition among teachers, not in an unhealthy way. We don't have to go from 0 to 60 miles an hour in 2 seconds. But right now, we're getting fought in local communities at the most basic level of just having meritocratic pay and having consequences if you fail as a teacher. That's just unacceptable. We're not putting teachers second. We're not putting unions second. We're just putting kids first. That's what we have to do. The schools are for kids, not for adults, and we have to get that across. And Mitt can do that even at the federal level. There are federal block grants that go to schools for children with learning disabilities and children of low income. Mitt should direct that to schools that are competitive schools and schools that are trying to make a change. So it's a longer conversation, but I think there's quite a bit that can be done at the federal level to encourage competition among schools. It doesn't mean to get rid of public schools, just makes them get better.
Tax rates. I hear that Mitt wants to lower tax rates.
That's a misnomer, Alan. He wants to keep the tax rates roughly where they are. The trade-off, I'm being kidding a little bit, but he wants the statutory rate to go down to the 25 to 27% range, but he's also working through a significant number of loophole reductions. So the net effect is not this massive tax cut for everybody, but it will definitely be a lower statutory rate. And then depending on the deductions that you take advantage of, you may be having less deductions, and then the rate may not be quite as low as you think it is. So I think what really is going on here, I think the real debate is, do you maintain the generally lower tax rates of Bush, or do you increase them? Because there's no reduction. Really, I think it's much more we should focus on. Obama's increases are 3 to 4% on the marginal level for higher income people, plus taxes related to Obamacare and others that he's inserted that are not even well articulated today. There's going to be a dramatic difference. And as many people understand, it's not just wealthy individuals. Most small businesses today have passed through economics, so they pay ordinary income tax as a business, and these are for owners of small businesses. So they're going to see a really big increase in taxes if Obama's reelected.
You know, I tend to agree with the concept of marginal tax rate. I mean, today the marginal tax rate is around that 25%. It's just calling it what it is, calling a spade and putting it all in line. Good things. When we look at the QE3, the perception is that if you put QE3 here, cheapening the U.S. dollar will elevate the strength of everyone else's currency against our own. Do you agree or disagree with that?
Well, I think from an macroeconomic view, that's probably technically true. But a lot of other things that are woven into the strength of your currency beyond just the interest rates. Obviously, if our costs are lower, if we can produce more cost effectively, we actually can have a stronger dollar because we can be a stronger importer. So I think there's more to it than just the QE3 piece. And I think MIT is going to be very discouraging of the path of stimulating our economy by more free money. I think it's much more focused on the things we talked about to drive jobs, not free money.
Thank you, Dick. Dick, it's been a pleasure visiting with you today here on America Dreams. And best of luck to you. You're running the Northern California campaign.
Yes, sir.
Also working with MIT on the...
We may not win the election in California, but we're doing very well in fundraising.
Thanks for joining today's show.
You're listening to American Dreams with Alan Olsen on AM 1220 KDOW.